Welcome to a special episode of Stock Investment Analysis. In today's video, I will show you the Excel sheet I use to analyze and compare different companies when I'm doing research on which one to buy. I'll demonstrate it by comparing Walmart and Target. This video topic was requested by Chester Bean, so I hope this is helpful to Chester and others who watch. Before I show that to you, I would like to announce the winner of the contest in my last video. The first person who correctly named a company I had invested in during the last month was Kevin Hagen. Now, many of you did answer correctly, but unfortunately he was the first, so he wins the prize. Feel free to check out his channel at Kevin Hagen Investing. He received the $99 subscription to Div Tracker. Please take a moment to like and subscribe to this channel because I will be doing another $99 giveaway next month and I don't want you to miss it. Now on to the video. Before I show you my Excel sheet, I want to first emphasize that this is not all I do or look at. I also look at resources like Fast Graphs, Seeking Alpha, Fidelity, FinViz, Macrotrends, and Finbox. I also go through the company's various statements and presentations. Make sure you watch this video to the end because I will show you where I get all this information from. Here's my Excel sheet. What I like about this Excel sheet is it takes a huge amount of data on two or more companies and puts them all together in a single page I can look at all at once. When I look at those other pages and resources, there is a lot of information spread out. This allows for me to compare an enormous amount of data all at once. I have been using this sheet for several years, but I did add some comments to it today to help some of the newest investors who are watching this video and are less familiar with some of the metrics we will talk about. For some, like price to earnings, price to sales, dividends, and so on, I have already made videos on these topics and I encourage you to watch those if you are unfamiliar with these concepts. If you are confused by some of what I list here and I do not have a video on this topic, please write me a comment and let me know what you would like to see. Now, as you can see, I've organized the sheet by up here, company characteristics, historical growth, forecasted growth, dividend, returns, valuation, margins, company safety and stability, and future. You may organize it differently, but this is how I organize it in my mind, so this is how I made the sheet. I will take you step by step through this. First, we have the ticker right here and the name. Walmart is on top and Target is on the bottom. While many people consider them as very similar or nearly identical, they are actually in different sectors and industries. Walmart is a consumer staple, and Target is in consumer discretionary. Both are based in the US. I invest in mid to large cap companies, so both companies are at a market cap that I would like to see and are both investable for me, although Walmart is of course clearly much larger. While some might see that as a benefit because it's going to be more staple and it's larger and maybe can get better deals on certain contracts, Target is smaller and some might see that as a positive if they think that it is an indication of potential for greater growth. Moving over, we look at historical growth. Many people will tell you that historical growth does not guarantee future growth, and it doesn't. However, it does give a context and a better perspective of the company's performance and what it is capable of. I much prefer to invest in a company with a strong past performance than one with a weak performance. First, we have the 1, 3, 5, and 10-year earnings per share growth rate. Target wins across the board by a decent margin, especially in this most recent year. Next, we have the 1, 3, 5, and 10-year cash flow growth rate. Now again, Target wins in all categories and Walmart was actually negative for years 1 and 3 and it was flat for 5 years. I next have 5 years of sales growth, which Target wins again, performing about twice as well as Walmart. And last, I have 1, 5, 10, and 20-year price performance. This is mixed as Target did better at 10 years, but Walmart did better at 1 and 5 years, and they were nearly even at 20 years. Based on this, Target is the winner and has much better growth performance. Earnings and free cash flow are particularly important to me, especially as a dividend growth investor, so this is a pretty big win for Target. Next, we look at forecasted growth. Again, Walmart is on the top. Now the first column is current earnings per share. I only have it in forecasted growth for the purpose of comparison as this is a present earnings per share and not a future. Beside it, I have estimated earnings per share growth rate. This is the rate at which analysts are expecting these companies to grow their earnings per share annually. You can see that they are expected to grow at a very similar rate. Now we have estimated earnings per share. This is what Fast Graphs estimates based on analyst forecasts the company's earnings per share will be in several years. In the next column, we have the estimated earnings per share target price. In other words, based on fair value and what the analysts believe these companies' earnings per share will be in several years, at what price should their shares trade at? Walmart is expected to have a target price of about $92, and Target is expected to be at $110. Next to this, I have the current share price. As you can see, the current price is actually higher for both companies, particularly Walmart. Now you might wonder why Fast Graphs thinks these companies will grow over the next several years and yet should trade for less money. The reason is valuation. Fast Graphs sees both as being overvalued. If they return to fair value, even with earnings per share growth, the share price should drop. How much, you ask? That is in the next column, which is estimated earnings per share total gain or loss. Walmart should lose about $24 per share, and Target should lose about $1 per share. Now, you math wizards out there might notice that if Target drops from almost $119 per share to $110 per share, that's more than a loss of $1.09. That is correct, but this $1 loss is calculated with the assumption Target will continue to pay its dividend. This will mitigate the overall loss seen from share price dropping. The next column calculates the percentage loss expected. We see that Walmart is forecasted by Fast Graphs to lose 19%, whereas Target would only lose 1%. Because this would be over several years, the annual rate of return would be negative 5.6% for Walmart and negative 0.34% for Target. Now, other analysts will of course disagree and will base expectations and fair price target calculations on different metrics. So I like to consider several sources. The analysts listed by Finbox expect a higher price target than Fast Graphs. Their mean price target is $134 and $130, and the median price target is $138 and $133. These analysts are also therefore expecting a better change in share price for Target than Walmart, agreeing with Fast Graphs on Target over Walmart, but disagreeing on valuation. Finbox has its own fair value estimate, which is favorable to Walmart over Target. Based on all this, however, I give the win to Target and see better potential growth and returns for them. Now next we have a dividend. As a dividend investor, this is very important to me. The yield for both is low, with Walmart at 1.73% and Target at 2.22%. Usually I want to see at least 3%, but I make exceptions for fast-growing companies like Microsoft, Apple, Visa, or MasterCard. Unfortunately, Walmart and Target are not fast-growing companies, so this yield is too low for me. Still, Target wins. I like a payout ratio of less than 50% or at least no more than 60%, so their 40% payout ratios are great. Next, we have 1, 5, 10, and 20-year compound annual growth rate for the dividends. Target wins for every single one by a large degree for all but the 20-year, which is only won by a small margin. Next, we have the Chowder number. Many of you may be unfamiliar with it, but the Chowder number is a metric which combines current dividend yield and dividend growth rate. If you are investing in a company with a low yield, you will expect a higher growth rate to compensate. If a company has a high dividend yield, let's say 6% for example, we can't expect 20% dividend growth. The Chowder number allows us to compare companies with different yields and growth rates. As shown here in this comment I made for you, if a company is above a 3% yield, we would expect the yield plus growth rate to be at least 12. If it is under 3%, we would expect the yield and growth combined to be at least 15. Sadly, both are under 3% yields, as we can see here, so we would expect a combined growth of at least 15. However, obviously both are not even close to 15 or to 12. Therefore, they both fail the Chowder rule, but Target does beat Walmart by a significant margin. Last, I have what analysts on FastGraphs are forecasting for a future dividend payment and the estimate for the dividend growth rate. Target wins for estimate growth as well. Next, we have returns. For those of you who don't know the differences between the returns, return on assets, as I show you here, is an indicator of how profitable a company is relative to its total assets. It is a measure of business efficiency. Return on assets takes into account a company's debt, unlike other metrics such as return on equity. Now, Target wins here at 7.8% versus 6.3%. Next, we have the 5-year compound annual growth rate for return on assets. Target is only listed as 0% here because I didn't have the information when I made this video. I don't believe the growth rate is actually 0%. Next, we have return on equity. Return on equity also measures how efficiently or how effectively management is using a company's assets to create profits. The long-term average for the S&P 500 for the return on equity is 14%, so I like to see at least that much. Both companies surpass it, but Target wins. Target's growth rate over the last 5 years for return on equity is quite good, whereas Walmart's has actually been decreasing over this time period. Target wins this one as well. For return on investment, which is the gain or loss from an investment relative to its cost, Target wins once more. Now let's look at valuation. Generally, I don't want to invest in anything with a PE over 20, but I prefer a PE of 15 or below. That being said, certain companies in some sectors trade at much higher valuation ratios, so I like to consider valuation on a comparative basis. I prefer to see how a company's valuation compares to where that company usually trades and to where other similar companies trade. As a result, after the PE, I've listed the 10 and 20-year normal PE for the company. We can see that Walmart and Target are both trading well above their normal PEs. In other words, they are overvalued compared to where they usually trade relative to their earnings, consistent with what FastGraphs showed above. That to me is another red flag that both are likely too overvalued to buy now. But again, Target is looking better. I look at 4P, which takes future earnings into consideration, and Target is 5.5 less than Walmart, making it look much more attractive. For a PEG ratio, or the price to earnings to growth ratio, I like to see a 1 or less. Both are well above this, but Walmart is almost double Target. Price to free cash flow is higher for Walmart than for Target, but both have a higher ratio here than they have for their 5, 10, and 20 normal price to free cash flow ratios. Price to sales and price to forward sales are nearly identical for the two, and price to book is similarly almost the same. The average 5-year price to book is lower for both companies, again showing that both are looking overvalued. In fact, when I compare Target to its industry, its PE is at the 50th percentile, but the PEG ratio is at the 88th percentile. Price to free cash flow is at the 73rd percentile, price to sales is at the 75th percentile, and price to book is at the 75th percentile, again showing that these are all high and not where I'm looking to buy. Last, for this section, we have the Piotrovsky Score. The Piotrovsky Score is a number between 0 and 9 that reflects 9 criteria used to determine the strength of a firm's financial position. We use this score to determine the best value stocks, with 9 being the best and 0 being the worst score. For every criterion met, 1 point is awarded. The points are then added up to determine the best value stocks. So Target's 8 puts it very close to being one of the best, whereas Walmart's 6 is close but loses to Target. So in summary, both are overvalued to me, but Target is looking better. Next, we have margins. Target's gross margins come out ahead, as do their operating margins. Walmart's operating margin 5-year compound annual growth rate is faster, however. Target wins again on profit margins and is growing them more quickly, though both are growing slowly. Finally, we have company safety and stability. We want to buy companies that are financially healthy and allow us to sleep well at night. Long-term debt to equity and debt to equity are both high for Target, and I would like to see something lower. That being said, long-term debt to equity for Target is at the 59th percentile for the industry, and their total debt to equity is at the 42nd percentile, so this is not unusual for a company like Target. Short-term debt coverage, as we can see here, is the ratio of operating cash flow to the sum of short-term loans. That is, it shows how well the cash flow from operating activity covers short-term debts. I want to see at least a 2, but the higher the better. Both companies surpass this, but Target does so long-term debt 20, whereas Walmart only does so at 3. Is again higher in debt. Similar to short-term debt coverage, interest coverage is used to determine how easily a company can pay interest on its outstanding debt. I like to again see at least a 2, but 3 or more is preferred, and the higher the better. Both are well above a 3, and Target is slightly above Walmart. The debt paydown yield is a change in average of 4 quarters of long-term debt over a company's market cap. The higher the number, the faster they are working to pay down that debt. Neither is impressive, but Target is actually negative, showing it has taken on more debt. Both have a good credit rating with Standard & Poor's, but Walmart's AA is higher than Target's A. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. A ratio under 1 indicates that a company's debts due in a year or less are greater than its assets. Both are under 1, but Target looks better here. The quick ratio is an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. A result of 1 is considered to be the normal quick ratio. It indicates that the company is fully equipped with exactly enough assets to be instantly liquidated to pay off its current liabilities. A company that has a quick ratio of less than 1 may not be able to fully pay off its current liabilities in the short term, while a company with a higher quick ratio than 1 can instantly get rid of its current liabilities. Both are well below 1, which is unfortunate, although Target beats Walmart here. The free cash flow yield is a financial solvency ratio that compares the free cash flow per share a company is expected to earn against its market value per share. Generally, the lower the ratio, the less attractive a company is in an investment, because it means investors are putting money into the company but not receiving a very good return in exchange. A high free cash flow yield result means that a company is generating enough cash to easily satisfy its debt and other obligations, including dividend payouts. I usually like to see at least a 5, which both exceed, but Target comes out ahead. Finally, beta is a measure of a stock's volatility in relation to the overall market. By definition, the market, such as the S&P 500 index, has a beta of 1.0, and individual stocks are ranked according to how they deviate from the market. A stock that swings more than the market over time has a beta above 1.0. If a stock moves less than the market, the stock's beta is less than 1.0. Now, while traders may like a high beta, a long-term investor like myself prefers a low beta. Overall, Target has more debt relative to its assets and equity than Walmart, which I don't like to see. However, it is better equipped to manage and handle that debt and interest based on its cash and free cash flow. Based on this Excel sheet, I see Target as consistently the superior company. The last piece of this puzzle is to examine whether a company has a moat and its future. Some people call this the story. Where do you see the company going? Do you believe one will take more market share from the other? Do you believe that they can compete with Amazon? Will they fade or prevail? Some of this may be based on personal experience, but I like to research this as well. However, there are no hard numbers I can use as this is subjective, so I don't put anything in the Excel sheet related to this. Brief examples of things I would consider include Target's new Instagram checkout, Target's acquisition of Deliv to assist with its growing online orders and improve digital growth. I gather my data from screeners like FastGraph, shown here, FinViz, shown here, and Finbox, shown here. I also get information from Fidelity. I use data from all 4 of these sources to create this video today and provide you with the data I explained. With the exception of the chowder number, I did not get information from any other sources, so all this data was 100% from those 4. I'll wrap this video up here, but I hope this has helped you to get a better understanding of information you may want to consider when deciding whether to invest or when comparing 2 companies. Make sure you subscribe because I will be creating new videos for you every week. As always, good luck with your investing.